Hi, and thanks for tuning in to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Paul Kim, who's the CEO and co-founder of Simplify, an ETF issuer with over $2 billion in assets under management. Paul, thanks for joining me.
Nice to have a chance to talk to you today.
Paul, as you know, interest rates have shot up through the roof recently. You can get risk-free yields of 5% or more in things like money market funds, ultra short-term bond ETFs, and things like that. But your fund, the Simplify Enhanced Income ETF, ticker symbol HIGH, aims for even higher returns by utilizing an option spread riding strategy. Can you tell us how that works?
Well, it starts with the very attractive rates in T-bills. It has basically 100% T-bill portfolio. And then we're going to sell various call and put spreads on top. The true innovation is taking that sort of option-based income and trying to make it a diversified basket of options where we have a sort of a systematic approach that looks across different asset classes, equities and bonds, and looks for very attractive vol to sell. We want to sell it in a very risk managed way, which means spreads, right? So you don't have any sort of big gap risk. And then we're further trying to diversify the exposures. So we're selling things that tend to zig while other things zag together. And that basket in aggregate allows the NAV to be pretty stable and let us sort of generate this attractive return.
Interesting. So you have that T-bill portfolio and then you have the options writing strategy on top of that. How much yield can you get by employing this strategy?
We've been able to deliver about a 9.5 sort of distribution yield consistently without a lot of additional risk. So very high Sharpe ratios, no credit risk, right? Because we're not buying any corporate bonds or anything like that. And very low duration risk because we're really buying, call it 3 months T-bills on average. So it's a very low risk portfolio where all of that incremental risk is generating a nice fat distribution.
That sounds really compelling, 9%. Where could it go wrong? In what situations could there be risk to capital?
Sure. So first, if the T-bills ever lose money, which they rarely do, it's we view T-bills to be one of the only true safe assets out there, right? Even relative to other treasuries. So that part, and then the other part are if the options lose more than sort of the premium earned. And there, again, we're very risk managed. We have ways to sort of mitigate risk by using spreads, offsetting positions, and we also have risk management systems in place. So if we ever get near to the strikes of these options, we'll take them off. And we're not ever really having a large amount of options. We're talking basis points of premia in any period. The whole point is to try to sell a little bit in each weekly period and just clip that little extra premium income. And ultimately, the protection of losing money is also the yield. So if you start with 5.5 in T-bills and another 4 in options, that's a lot of yield that sort of cushions drawdowns.
That makes a lot of sense. Now, another one of your fixed income ETFs is the Simplify Aggregate Bond ETF, ticker symbol AGGH. Can you tell us a little bit about this one?
Sure. So relative to high, which is no credit risk and very low duration, I think AgH is the same concept, except it's really trying to tie itself to the Bloomberg aggregate index, right? The core plus fixed income benchmark of choice for most funds. And so here we're trying to take similar concepts of selling options and sort of being strategic about the exposures in the funds, but we're really saying, look, anyone who buys AGGH, is ultimately they want duration. They're hoping that duration leads to either capital appreciation or portfolio diversification. So for investors who want that duration, we want to create a portfolio that also generates a lot of yield and looks and acts a lot like the core fixed income that they want. And in this case, it generates over 10% yield with a pretty similar duration range as the aggregate bond index, and without taking massive, sort of overweights to any particular sector.